mean, Nicole, a lot of what's been going on this year, obviously COVID, right? Let's just put that out there. Uh, I'm sure there's been repercussions, and I'm sure that there's been some things that have changed. What are you seeing so far from, from the last year, just 2020, not even moving forward?
So I'd say, obviously we all know that from March on, COVID has caused somewhat of a settling in the private money world. There was very little lending taking place due to restrictions that were put on. I think the biggest impact we've seen is in the commercial division on that. As far as residential properties, which are single family residence to 4-unit dwelling, we didn't really see the impact as hard there as we have the commercial side of it. And there's a lot of reasons, and I won't dive into the minute reasoning behind that. But the reality of the situation is you take an area, I always like to put it towards your area because, of course, it makes sense to everybody who lives in the New York market. But basically, when you look at an area, say Manhattan, you have commercial, mainly commercial in Manhattan. And what has happened there is that we saw an exit of everybody in the commercial market leaving, whether, forced because they wanted to. You're seeing a lot of pressure on the suburban areas on the outside for the residential people who have left. But I think your market, your commercial market is going to see an effect for probably 5 to 10 years, because on a small level, you're seeing that everywhere in the country, right? So your big cities, and not even your big cities, look at your, the schools have been affected, your colleges have been affected. A lot of people invest in college areas because, it's a good area to invest. Well, why? Because coffee shops are popular amongst, college students. So the commercial market, I think, is where we're going to see the heavy impact from COVID. And that is going to be, in my humble opinion, long lasting. So I think we'll see the commercial market affected by COVID. As far as overall 2020, we've seen a nice large increase in market values in 2020 from 2019. I think my last research was a little over 13% increase in your residential market. So we're still in a supply and demand issue in 2020, even with COVID. Yes, your private money guys out there, I know you guys saw that slowing, but with slowing, with commercial being down, brings opportunity. And you're definitely going to see that. It's about making smart decisions and going after things that might be a little bit on the riskier side. But I definitely think your commercial area is where you're going to see opportunity over the next 7 years. There's going to be a decline, which is definitely going to impact the market heavily. And in some cities, I think it's going to be hit hard. Your Manhattan of the world, it's going to be hit hard. Your Brooklyn, that's going to affect everybody. And that ripple effect happens to everybody in the market, right? Because if commercial is affected, obviously you see the effect all the way through. So those would be my biggest takeaways from 2020 and COVID. You saw a nice increase, probably one of the largest actually we've seen in years on your resi side, but then on your commercial side, you're seeing a dip already. It's very small, even minute at this point, but you're seeing it. I don't think we'll see the real effect of that, if I'm being honest, until later 2021. The other thing that I think you've seen, obviously, a slight increase in default market. So you have seen your conventional lending where we've seen a little bit more default. And some of that I think is opportunity. If I'm assessing things correctly, I think people think that it's okay to default right now. And I think that they think that that is something that is allowable by banks and things. So they're trying to get away with that. Some of it is not. Some of it is that people are truly in trouble because they've lost dual income households have lost one income or maybe even both. And so you have a default market that has escalated. Don't think we'll see the full effect of that until probably June 2021. So look for some opportunity for your, private money investors. Look for some opportunity towards the end of summer next year, I would think, in that default market. Be looking for that opportunity. I don't think we've hit the tip of the iceberg yet because of the ripple effect that will happen here in the next, 7-8 months. That's my projection. So
I mean, a lot of what you said, we've definitely seen already from what's current, right? The markets, the residential markets have increased astronomically this year, like you said, more increase than we've seen elsewhere. That conversation keeps coming up, which to me is super interesting because from where to where, but as you look at the full picture, it starts to make sense, right? A lot of the commercial gets affected, residential comes up, right? Everything's a little bit of a seesaw in this market, and that's real estate.
Absolutely.
And, the next thing that I want to ask you is actually, right now we just finished an election where we think we know who our president is. And this is not supposed to be, just to be very clear, I don't want this to be a political conversation. Whoever you voted for, we commend you for that, and I respect you for voting to begin with. The question is more, so
I still can laugh over the situation though.
Oh, for sure. No, 100%. It's pretty funny that we don't know who our president is yet, and it's pretty December. But that's America for us, right? So here we are today, we're unsure. How do you see, or how could the elections actually affect our market?
Well, I think the biggest impact is going to be, if Biden is our president, we're going to see tax impact that is going to affect your investment market. And that's going to be the biggest. And again, that's going to affect your commercial market again, because your heavy taxes are going to lay within your commercial market. And so, but the tax effect with a Democratic president period is going to affect us. Whereas if Trump stays in office, which is obviously highly unlikely at this point, but even still, you look at that and that's a more positive outlook due to COVID because of that double impact you have. So you have the impact on the commercial market, that again, the ripple effect will come down and affect everything. And then if you have also the extra tax on those commercial properties, I should have laminated something. I saw something recently and then I did a little add to it to see who would be, how our taxes would affect if we were looking at a commercial investment property of say 6 million and how our taxes would affect that. And basically what I did is, being an appraiser, you can look at that, your net income, your gross income, and then what your bottom line is, because that's what we're all looking at, right? And on the same property with Trump and his tax expectation and Biden and his tax expectation, you would be about 26% negative on that same investment as you would as a slight positive with Trump because of the tax effect. So if I hand wrote it, but I'll make a copy of it. Maybe I'll send it to you and we can broadcast it or something. But if you look at that, you look at the effect of something like that can already have on an already waning commercial market. So your investor who might have been willing to make an investment and maybe not have any profit at this moment because his investment is his property, obviously, right? Whereas if he's going to be upside down and taking on some of that burden, is he going to make that same investment? I don't know. You tell me. So there you have your investor being affected by the tax market, again, already on a commercial market that's waning. But hopefully the positive is that in your commercial market right now, we're going to see values come down because supply and demand would tell you that, the supply is going to be an overage, your demand is going to be low. So what's going to happen? Our property values on commercial properties are going to plummet. So then the tax effect is going to maybe be better. So it can be looked at positive or negative. It depends on how that impact of COVID happens and whether we go this way or this way. I got the hand movements going today, Max, for you. So anyways, your bottom line may be affected by COVID, which will be a positive thing, I guess, so to speak. I hate to see an area like Manhattan affected as much as it is. And I think we probably are looking at probably 7 years there, but maybe, if, your supply and demand goes the other direction, I'm telling everybody right now, go invest in Manhattan, and maybe you'll get a spur due to that, and it will correct itself. And so we'll go like this instead of this big dip. You might get this, and, with some outside influences from other countries, seeing an opportunity, opportunity not to, never know. United States is, the greatest country in the world. So if that holds true during all of this, which, I don't have a crystal ball. I wish I did. I'd be a billionaire for sure. But I know I just crack you up, don't I?
You come out with all the best strategies before they did if you had a crystal ball.
Yeah. I mean, that's what we're here talking about, right? That's about, sparking an interest. Yeah. You spark some talk, you start thinking about things. You got 40 people, all their wheels are starting to spin, and people are starting to think, oh yeah, what about that? And that's what we're hoping during these podcasts to enlighten somebody who might, spark an idea and go off in a direction, and maybe those markets will correct themselves because people will get out there. But I definitely think your supply and demand in your commercial market is going to be upside down for a while, obviously. I mean, hello, everybody knows that right now. And it's about where we start investing and what starts happening. And if people see a need, it could correct itself. But I don't see that in the Manhattan area, unfortunately. Right. But we'll see.
And hey, look, when we see spots like this, right, I always tell all of my borrowers, right, their profits are not made in your sell, they're made in your buy, right? So the better you can buy it for, the more your potential is to make on it. So if you can find a unit or a building right now in Manhattan that maybe bought at 40, 50 cents on the dollar, does that make it a bad deal because Manhattan plummeted? No, that's actually your opportunity. So I just want to clarify that a little bit. And also, I would love to add in, the perspective of market value. And as an appraiser, you probably see this all day long, but from a investor, from someone as a consumer, even market value is super interesting because it's really about perspective, right? It's all about what the highest someone will take and the lowest someone would pay for a property. And that's what we're seeing being affected right now. One thing I'd love to add into that is, I was asked, a couple of times this year, the same question, similar about the presidential elections and how I, kind of saw it and viewed it. And I have extremely similar views as you do, right? The tax could affect the properties. But at the same time, also, we've noticed that what happens is the market values adjust themselves to those taxes, right? So now your appreciation may go down a little bit because the taxes are maybe stopping it from going up. But does that mean the market's going to stop? I haven't seen that yet.
Well, and I mean, your first point is a very good point because, I mean, market driven, what's the market driven by? It's driven by us. So if we're sitting here on this call and we're talking about Manhattan, which we are, and we're saying, maybe look to Manhattan for an investment. Has the market corrected itself enough to get those people to look at that? Probably not. Although I think on our last podcast, we were talking about an appraisal in Manhattan. And I literally had an appraisal 1 year ago in Manhattan on a condo it was a co-op building of 8, I want to say, but either way, it sold for, and don't quote me, but you wouldn't, 2.2 million last year at this exact time, before the end of the year for sure, and just appraised for 1 million. So they lost 1.2 million on their investment from last year at this time. So what does that tell you? obviously people are getting a much better deal than they did a year ago, 2019 at the end of the year. And somebody, or a couple of people at least, because they need three comparables to give a value, had a really good deal in comparison to the people last year. So there's your opportunity.
Right.
And market is driven by those people. And not a lot of people are willing right now to buy a condo in Manhattan. People are in droves running to the suburbs, and your suburbs right now are really high. So that's not your investor's dream, because everybody in your, the rest of the world, your conventional market is now running to buy in the suburbs. So let them all run. And then where are we going to go as investors? We're going to go to Manhattan and get something for $1 million less than what some conventional person invested in last year. It's about, seeing our opportunity. But then that drives our market, right? So if we tell everybody, hey, go to Manhattan, I just gave you a clue in, there's condos going for $1 million less, and all of a sudden you have 10 people who are investors all there bidding on the same properties, what's going to happen? Our market's going to correct itself a little bit. So, it's those areas that we're not talking about, people aren't clued in, that are having these problems right now, because as the, commercial dives down, everything dives down in that area. And when it's condensed, like with an area like Manhattan, that's where it's going to happen. And that's what COVID has done to our marketplace. The biggest impact anyways in COVID has done to our marketplace.
For sure. Yeah. And I think even before COVID hit, I think everyone could have expected that New York would probably be the most hit, just because of, like you said, how condensed we are, but not only on a market level, but also on a science level when it comes to COVID, right? So I guess it all in 2020, hindsight is always 2020, right?
100%. Don't you like that? Hindsight's always 2020, and in 2020, it's literally.
I didn't even think about that one.
You should clone something. Oh wait, what did I say? Clone it, not clone it. All right.
I think we had a different trademark on our last webinar too. This really sparks something every time.
Watch out.
There's always good ideas passing through here. That's what we are always trying to do. So another thing that we discussed a little bit, even when we were speaking today, was percentages of increase on the housing prices since 2019. We've seen, right? You just mentioned it to us also, such a big jump. I mean, where do you think, or where do you see it coming from?
I mean, the increase started really in 2019. So, and that's your conventional market. So really what you're seeing is like, kind of like what I was talking about, how we're going to see our default market really hit in summer of 2021. You see the impacts of last year's market and the decrease in the rate overall that happened towards the end of 2019 and then was coming up in 2020. You really see that increase effect in the bottom line over 2020. So it was obviously the decrease in rate that's been substantially lower than we've ever seen in our history. And we were in one of the biggest booms we've seen since 2007 in March of this year, before COVID hit. And there was suspicion about COVID, so we were keeping people motivated with the rate and things like that. And we were already in the biggest boom we were seeing. So that effect still came through COVID. Of course, in your world, in the private money world, everything stopped and it went down. But in the conventional world, everything was still skyrocketing. And if anything, the restrictions were loosened up. I always hate to talk about this because it feels like, we're doing something we shouldn't be doing, but the restrictions were loosened up and the lending was very easy. You could get, a desktop appraisal, Fannie's doing their waivers, and a lot of people were getting waivers during COVID, a high number, way more than we've seen in a long time. So less restrictions. And people were
5 to 7 years too.
there you go.
Right?
So, yeah.
Really show up. I love it.
Yeah.
And yeah, I mean, like you said, rates were extremely low to begin with, and
they still are.
And I think we're still in the negatives, if I'm not mistaken.
Yeah, and I think that just to kind of touch on that, why we're here, I really think that we're going to continue to see that through. I mean, obviously, the end of the year with a new president, whoever it is that comes in. I mean, are we going to see a rate increase? Absolutely not. I mean, I would fall over and have a heart attack if we saw a huge rate increase. So we're going to see a steady increase. We're going to see a steady market. I would predict it at least until March of this next year. And if I was a betting person, which I am, I would say you're pretty safe through the good part of 2021. That's my prediction. There's economics out there, I can say it today, that are predicting that we're going to see that through even 2022. I don't think that. I think that we could see some increases towards the end of next year, depending on how we do through this year and how bad the default market goes. So a lot of variables that are going to come into effect there. But I think that also brings a lot of opportunity for the private investment world. So those guys should get out there, and the more they spend, then the more the market will go up too. So did I answer your question?
You did.
I felt like I went off on a tangent.
You answered the question and more, actually. So I definitely appreciate that. So I guess let's pull out the crystal ball now, right? We could rub it a little bit.
Cute.
I know we kind of went into predictions a little bit on the commercial market as in 2021. We went into predictions a little bit on rates, but I guess now let's go into an overall standpoint. I mean, what are you kind of seeing going forward in 2021 in regards to the conventional market? And I guess if you would also add in a little bit of the private money world.
So definitely on the conventional market, I see a steady 2021. I see interest rates still historically low. I could even see, if Trump becomes our president, getting a decrease again. If Biden is, I think we'll stay level, but I think he'll keep it, I think we'll stay low. So I think interest rates for that world are going to be definitely good. And so I still think you're going to see a steady, we have a supply and demand issue. We are definitely under supply right now. So that's going to keep the market going up because of that. The builders should get out there and be building. It's a good time, although if you do the research behind that, not to go all into that prediction, but, again, construction is a supply and demand world as well for your construction guys out there. I'm sure many people on the call can talk about that. And construction costs have gone up, and the demand, because the demand is low right now, and you can't get your hands on it. Your trucking world, your shipping world is very, very difficult right now. For many of you who during COVID went and tried to buy weights, you couldn't get your hands on it, right? Like weights went through the ceiling. I was trying to buy, 10-pound weights, and I couldn't get my hands on them. And they were probably, there was no shipping really coming in. So construction is the same way. We got to get that stuff from somewhere, and we don't have enough supply here in our own country. So here we go, right? So that is really low right now. But what we need is some construction to get that supply up, so that we have more houses for people to lend and buy. So if that happens, we could see, the investment world, get a little bit better, better or worse, depending on how you want to look at it. But the construction really affects the 2021 outlook, is I guess what I'm trying to get at. Because depending on how many construction people get out there, big companies, and start building, and then that will level off our pricing. Otherwise, the demand right now is so high, and we don't have enough housing. I see the market going, up. I would see an increase larger than what we saw, honestly, in 2020, which wouldn't be a good thing, in my opinion, because although we all want to see our property values go up with the supply and demand being so out of whack, I think it's gonna have a ripple effect. And I won't go all into it because I'll bore you all to death with all of that information. But I do think we'll have a terrible ripple effect that would happen if we don't get some more housing. And obviously it needs to be in the suburban areas because, again, as we touched on with the, commercial people are headed out of the big cities right now. We're going to have vacancy rates there that are going to be at an all-time high. And there's where your investors who are sitting on this call, hopefully, can have the opportunity. So I would look to big cities for opportunity, commercial space, but even resi, because obviously it's going to outlast anything right now, but because your supply and demand is out of whack, I think that's going to be where your investment opportunity is going to be right now. So that's kind of my prediction. I'm trying to think if I missed anything. Maybe you can remind me if you think I did. I would think an increase of similar to what we had this year, which is, I think, sitting at about 13.4 the last time I looked, was the overall increase for this year, which is huge. That's a huge increase. I think it's the largest. I didn't look. I haven't looked yet. I looked in July to see when the last time we had, because I was predicting in June that we were going to see that large increase this year. So it's been a good year. For people who have investment or property, period, we've all seen a large increase in our properties. So if you're in a position where you're retiring and you can sell your house, or you're a young homeowner and you can sell your condo and sit on it for possibly 2 years, is another key to independent wealth. People say, sell your property. If you've got $500,000 into your property, maybe sell it while the demand is high, hold on to that money, or invest it in some other type of investment property. Rent right now, although rental is really tough too, but if you go towards the city where your commercial properties and your larger commercial buildings, your rental might be a little bit cheaper and you're willing to rent. Say you owned, on the island, Long Island in New York, just to give a quick example. You owned in Long Island and your property used to be worth 1.5 million and it's currently worth 2.2 million, which is about what I would think you were at. Sell the property, you're say my age, and you could afford to sell the property. You make $1.5 million, say you have a loan on it still from when you bought it, when it was only 500,000. You have $1.5 million, say, just to round it. And then you go and you rent in the city in Manhattan where nobody wants to rent right now. It's a little bit scary. It's not the greatest place to live right now, but you can probably get cheap rent there right now. So do that for 2 years.
I know a lot of people right now that are actually moving to rent in the city because this is the first time they feel that they could actually afford it.
There you go. So there you have it.
Yeah.
And then rent in the city and wait until you find the best opportunity, or until the market corrects itself, the building starts to happen again in those areas where, I can't think of an area right now where I know the building would be good. I'm thinking like White Plains or something like that, but I know even White Plains is overdeveloped right now, right? But I'm trying to think of an area. You would probably know it better than me, and probably half the people on the call would. But wherever a builder is that he can build right now, wait for those properties to get an oversupply where 7 builders are all investing in building, and then go buy one of those properties. And guess what? You probably end up with a good $700,000 in your pocket for retirement. So those are the kind of things that I think, like, as an investor mind, you have to think like, where's the shift going to be? We all know Long Island is worth a lot, right? We know everybody out, and most people don't want to move out of that area. So, or maybe, you do something else. But that's like one example of, I think, a way that somebody, even just a person who's not a private money world guy could make some money.
Absolutely. Yeah. I know many people who have bought a primary residence in a place and were very lucky and fortunate enough for the prices to go up, and they then use those funds to open up their own business. And guys,
There you go.
one more thing that's kind of, coming to me, and it's something I've actually, I think we went over this on a different webinar, but I want to bring it back up because we mentioned the commercial markets, right? One thing that's really special about us as humans is that we adapt. We always find ways to create new businesses. There are a lot of businesses that we have today that never existed before, right? If you went back to the 1500s, the 1600s, 1700s, every time we see new businesses that come out. And honestly, the one thing that's been going through my mind is, hey, like, what are people going to come out with now? I've seen some crazy things like COVID stores. Like, sure, yeah, they probably won't be there forever, but this may be your opportunity. If you have an idea, you're trying to get something into the commercial space, you have a business opportunity, you may be able to get something in cheap, where you could then expand on it. Just a penny for my thoughts. But,
I'd pay a penny for your thought.
charge you $1.
Okay.
But no, I think we've gone through a lot of information, guys. If anyone has any questions, please do put it in the questions and answer field for us. I would love to get to it. This way, if there's anything else that's kind of going through your mind, anything that we've said that maybe sparked a question, feel free to let us know about it. We want to answer. We want to make sure that we're all kind of putting our minds together. So, Victor.
Yeah. You don't want to listen to me ramble on about geeky stuff too long.
I do. Hey, this is why we're all here, right? We all want to learn more about real estate, and that's why we're getting into it. We all want to create a legacy for some people. Some people, it's just they want to prove a point to somebody. Some people, everyone has their own motivation, but we're all here for the same goal. I'm going to go ahead and go ahead.
I said, I agree. I think this is sometimes where the best ideas come from, is just a bunch of people talking about what's happening, in the world, and somebody sparks an idea that works for somebody else. And that's where the best ideas come from. Need.
So Victor, just so you know, I'm going to go ahead and put our contact information for you in the chat box. So if that didn't work, hold up. And then, guys, anyone else has any other questions for us? I know we've gone through a lot of information, but just we'll give another minute or two for anyone to type in their questions. Here. All right. Looks like we covered everything for you guys then. And guys, feel free to reach out. We want to talk to you. Again, for Nicole, she's probably going to refer you back to us, but obviously if you do have a specific question that we need to get answered, we can always help get her on the phone with us and make sure we are accomplishing all of your needs, goals, and making sure that you are in a safe investment. That's really all we want to do, is make sure that we're able to work together. This is a round table industry where we all make money. None of us make money. So let's put our minds together. Let's connect. Let's get them some deals done.
Hey, if you need me too, I'm willing to help anybody. I'm Nicole Andrews at FastApp, and I'm Nicole at fastapp.com if you need me. I'm always willing to answer questions, as Max knows. And I will refer you back to Max to get your loan done, but we'll do your appraisal for you.
And I just want to add in there, again, so why is it important to know who us as a lender works with for our appraisers, right? It's good to know where your values are coming from, who's kind of working through all this. Because at the end of the day, me as a lender, sure, I may be able to see a certain value, but we're still relying on the appraisal to really show us, hey, this is what's happening in the market, right? I'm going to miss something, I might not see something, and that's what they're there to show us. And that's there to protect you as well. And one thing that I have to say is that, in the time that we've been working with FastApp, it's not just about value, right? We're not here saying, oh, I want you to make me the highest number possible. No, we want to know the most realistic number possible. And we want to know that we're getting the service that we need. So when there's a problem, when there's a question, when we want to make sure that we're getting the appraisal in on time so that we can close on time,
That's what they're there for. And her just being here, and Nicole, I know you're probably gonna hate me for this, but you just being here and really talking with them, even though you're not really getting anything out of this, you're here just to educate and teach. We really do appreciate that, and I want to make sure that that's known.
Thank you, Matt. I
Absolutely.
appreciate that. And I mean, obviously you guys do a great job too. We hear that in the industry. So everybody should look to you guys to get their loans done and come to you to bounce ideas off of. I mean, another reason why you do this is to spark interest. And I know that you're constantly thinking when you're talking to all the different people you do podcasts with to get different ideas going. So people should reach out to you too, to get those great ideas and capitalize on them. I mean, it's the time. Whenever, you have to make opportunity, but opportunity's there right now. And it's a known thing. When something like this happens, it creates opportunity. And, some people see COVID as a terrible thing, but economics wise, you see it as opportunity because, it's going to create something. It's just about us all recognizing what is going to be created out of it. So be ready. I mean, I think your big cities is where it's at right now. Said it first. Watch out.
Change the way you think, and the things you see will change around you. So yeah, I'm with you on that 100%, guys. Thank you so much for being here. And just so everybody knows, if this was enjoyable for you, please give us some feedback. Email us. We're going to go ahead and shoot out an email to you guys after with a recording of this, just so if anyone wants to revisit it, they'll also be on YouTube. And we do plan on doing this more often, so we'd love to hear what was beneficial for you, what maybe you'd like to hear more of, so that the next market update will be maybe a little bit more in tune for you. Thank you so much.